Hello, I'm David Bransbury, the Tax and Account Supporting Director here at CHC Accountancy. The slides you're about to see were written before yesterday's spring statement, but there's nothing on them that contradicts what the Chancellor said yesterday. I will confirm that if there are further details that have been enhanced. Next slide, please. It's my pretty face. Next slide. Yeah. Yes, corporation tax and dividend taxes are going up. However, the Chancellor still wants us to invest in equipment. The personal allowances are being frozen, but there was some help yesterday with national insurance for employees and the self-employed. Though the government does want more information on your income, especially if you're self-employed or earn rental income. Next slide, please. There are always ways of saving tax, but I would only recommend those that are efficient use of your cash. However, this means in some cases money needs to be spent before the end of the tax year, i.e. 5th of April. New slide, please. Any individuals can earn £2,000 of dividend tax-free each year. This dividend must be voted before the end of the tax year, but does not have to be paid. Only profitable companies can pay dividends, but does not include ones that have made profits. Does include ones that made profits in the past, but has not used up all their old profits. Yes, for the more profitable companies, the tax rate is increasing by 6 percentage points. That is effectively a 32% tax increase. Difficult for most companies, but there could be for some companies, they could move some profitable work into 2022 rather than do it in 2023 and then saving a bit of tax. So hopefully that's a way going forward. Next slide, please. And if you're a company and you spend £1,000 on a new computer, you can actually offset £1,300 against your taxable profits. However, if you're a sole trader or a partnership, it's only £1,000 gets that immediate offset. But you can actually spend up to £1 million each counting year to get this good tax relief. The Chancellor said yesterday they are looking at more measures on capital allowances from 2023, so that we could see some good things coming in forward. Research and development was also mentioned yesterday. The UK has low expenditure on it, but generous tax reliefs. They are looking to reform, but not to reduce the tax reliefs, but be a bit more specific. So we've got things to come. Next slide, please. Capital gains tax is payable on the sale of assets or on the gift of assets to connected parties like children. It may be you have shares you don't think will increase in value, but have gains. So selling them before the 5th of April may give you a tax-free lump sum. Also, gifting assets with small gains to say adult children may be part of inheritance tax planning. So that's something to consider. Next slide, please. For the tax year 2021-2022, a small salary and the rest is dividends is still the most tax efficient strategy. From April 23, this may be tweaked, but we'll be certainly calculating this over the 12 months, next 12 months to give you plenty of warning. The HMRC hates company cars, but the general government policy is promotion of electric cars. So as an electric car driver myself, I can recommend them both personally for tax reasons. So if it's that area you're interested, please make contact. I will talk for hours on the subject. Next slide, please. With a bit of time and planning, you can remunerate key staff in a more tax efficient way, which is good for both yourself and the employee. and it can make them feel a bigger part of the company. So it is an idea. For the tax year just ending, the HMRC are still expecting more tax relief from work from home claims. Going forward, though, they have reiterated that work from home expense claims is only where the employee has to work from home rather than they wish to work from home. If the employer does not pay an allowable expense, the tax relief can still be claimed by the employee through their tax return or a tax code if they don't do a tax return. As said previously, dividends don't have to be paid, but can be voted director's loan account. So you could save them for a future when personal taxes are higher. Next slide, please. Always the best option for husbands and wives is to be earning similar level. That's not possible, at least paying taxes at the same rate for the couple. Between £100,000 and £125,000, your effective tax rate is 60%. So if you have a spouse earning less than 100k, they'll only be paying at 40% or lower. Certain benefits like pension contributions have no consequence, or low consequences like electric cars. So potentially give up a £500 a month from your salary and have that invested in a benefit that is useful to you, and you will save tax. Next slide, please. From 6th of April 2022, the tax payable on dividends is increasing by 1.5 percentage points. So for a basic rate taxpayer, that is from 7.5% to 9%, 20% increase. So if circumstances allow, would it be better to move forward to a dividend to save tax? The downside, though, is that you will have to pay tax at least a year earlier. However, depending on the circumstances, it may be better not to pay dividend at all, because you'll be paying dividends at 37.5%. But you may want to wait until you extract the money out of the company later at 20%. Next slide, please. As the old saying goes, you can avoid death and taxes. However, with some planning, you can reduce your potential inheritance tax burden. Next slide, please. You can give away some money to charity. Your family will always inherit slightly less, but instead of giving a big chunk to the tax man, maybe you could give some of that to your favourite charities. When you decease, the executors of your will have to look at all your gifts given away 7 years before your death. If you give annual gifts below £3,000, that can be completely ignored, and so you have a smaller tax burden. Next slide, please. If your monthly income is £5,000, but you normally only spend £3,000 a month to live on, then giving away £1,000 a month to, say, your children or your grandchildren can be ignored for inheritance tax purposes. You can claim yearly gifts could be included, but you have to have a regular pattern. So after at least 3 years, say, of giving an amount every March, then you potentially could ignore those gifts given away. These days, pension pots can be inherited. The tax on your heirs depends on whether you're deceased before you're 75 or after 75. Finally, the HMRC hates trusts, but if you operate them properly, they can offer some tax savings. Next slide, please. The government wants us to save for our own pensions. However, about 10 years ago, some lucky people put some extreme amounts into pensions. So they've introduced a maximum you can have in a pension pot these days. The trend recently has been to reduce this amount So the amount needs this year, the maximum amount is £1,073,120. If you've more than that in the pot, you get a small tax charge. Most people can put a maximum of 40k per year into their pension pot and get full tax relief. However, if it's a personal contribution, it's actually £32,000 comes from your bank account and £8,000 gets paid into your pension pot as a tax refund from the HMRC. Next slide, please. Stakeholder pensions were introduced a number of years ago to encourage people to pay into pensions. They have been superseded for businesses through auto-enrolment pensions, but they still exist and you can put money in them even if you have no income. In the old days, you had to buy an annuity. These days, pensions are much flexible. So if you wanted to, you could withdraw 20% of your pot tax-free, never touch the taxable amount and leave that for your children. Next slide, please. There are plenty of places to invest your money. Some of them offer good tax efficiency, but typically the bigger the risk, the better the tax relief. Next slide, please. Basically, MTD, the HMRC want to keep your accounting records on a computer software and report this every 3 months to them. Next slide. HMRC started with VAT, and all businesses with VATable turnovers of more than £85,000 should be using the new systems and should have done so for a while. Slide, please. However, from 1st of April, this is extended to all VAT registered businesses. Next slide, please. The HMRC would prefer you to use a compliant accounting package that can transmit data directly to the HMRC and receive information back. At the moment, though, this is limited information like the 9 totals on your VAT return. They're not getting every single transaction. You can use Excel, but you need software to connect your Excel information to the HMRC's computers. This is called bridging software, but this is not a long-term solution. Next slide, please. Finally, the next big thing is planned from April 2024. This will affect sole traders and individuals with rental income, and they'll have to start using MTD software and report each quarter on their results. If your income is less than £10,000 a year, yes, £10,000 a year, then you are exempt. Partnerships and companies will follow after that date. Next slide, please. Thank you, and please get in contact with me if you've got any questions.